the market is a crazy place right now, especially for traders, because you have people, individual people like Elon Musk, that can put out a tweet, and that one tweet can make a cryptocurrency jump or fall by 25%. And now you have Michael Burry saying that he is shorting Tesla with a $500 million short position, and he also says that he's worried about the stock market potentially collapsing. What's up, everybody? I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. When you invest your money into a company, the whole idea in the past is you are investing your money into a company because you believe in the long-term value of a company. But when you invest in a company, you don't expect that its valuation to drop by 20% in just 24 hours. I mean, if a company is chugging along like normal, it's growing, it's making more money, you don't expect to hear that its valuation is gonna get cut because somebody tweets about the company. But this is the environment that we're in. We are in a very emotional environment where tweets, social media tweets, can make a huge impact on the valuation of your investments. I mean, even Elon Musk, the CEO of Tesla, has come out and tweeted about his own company. He came out and he said that he thought that Tesla was overpriced, and as soon as he did that, the Tesla stock crashed. But that shouldn't really be a surprise. If your own CEO of your own company and the founder of your company says that your company is overvalued, that's not a good sign. Now you're seeing the same thing happen in the cryptocurrency market. When Elon Musk came out and he said that Tesla was buying Bitcoin, Bitcoin skyrocketed. And then Elon Musk came out and he started talking about Dogecoin or Doggycoin, however you want to pronounce it. And as soon as he started doing that, Doggycoin went to the moon. And then Elon Musk went on to Saturday Night Live, and he didn't really talk about Doggycoin the way people thought he would. He called it a hustle, and as soon as he did that, Doggycoin or Dogecoin crashed. And then Elon Musk came out and he said that Tesla might not be accepting Bitcoin as payments the way everybody thought it would. And as soon as he did that, Bitcoin prices crashed. And so you have a lot of emotion, and this emotion is affecting people's wealth because people have money invested in cryptocurrency and stocks. And when people make these emotional tweets, or when people just tweet things, people get emotional and then they buy or sell. And this panic buying and selling is really affecting how much money people have in their pockets. And this is kind of interesting because we're talking about real people's money. You have people investing their life savings or going into debt to trade. Now, I'm not advocating for you to do that. I want you to be a smart, long-term, fundamental investor. But the reality is some people want to make money in the short term. And the best way to do that is by trading. But you also got to be careful with your emotions when you're trading. And right now, we have a lot of retail amateur traders coming into the market, which is a good thing. Nothing wrong with that. But when you're coming into the market for the first time and you start tasting a little bit of success, and now you start to leverage up your bets because you got easy access to margin, meaning debt from your stock brokerage, and now you're trading more money than you can afford to lose, and now you're trading emotionally because you're trading just based off of what's hot and what people are tweeting about. Now, this is when things get kind of risky because you want to make sure you're not on the losing end of what's going on. And Michael Burry, the famous investor when the 2008 crash happened, because he was the person that shorted the entire housing market before it collapsed. If you've ever seen the movie The Big Short, that was about him. So when he shorted the housing market, he made a ton of money. Now, he has some things to say about the stock market. He's worried about the strength of the stock market. He said the stock market is walking on a knife's edge, and he's also shorting Tesla with a massive $500 million short position, meaning he thinks Tesla is going to collapse. Now, before I get into what Michael Burry is saying and why he's shorting Tesla and why he's so worried about the stock market, two things. First, if you haven't already, hit that thumbs up button below, because when you hit that thumbs up button, it helps YouTube share our video with other people, and I'd really appreciate that. And second, if you haven't already, I want to let you know that we have created a free Discord server. This is a place where you can come and chat with other minority mindset thinkers. We call our free chat room the Guac Talk community. So you can come here, talk about the stock market, talk about cryptocurrency, talk about real estate, talk about money management, and all things minority mindset. We even have a channel for guac recipes. So if you haven't already, please join our free Discord server. I'm on it too. So if you want to come chat with other minority mindset thinkers, I got the link to where you can do that in the description below. Michael Burry really rose to fame after the 2008 crash because when the housing bubble was brewing, he was one of the people that really started to take a step back, and he was one of the first people to question what is going on in the housing market, because back before 2008, everybody, bankers, real estate people, everybody thought that home prices could only go up. And so he started to dig deep into the numbers and he started to get really worried. He saw that banks were lending people money who couldn't afford this money, and it was all based on the value of homes. And he started to realize that everybody assumed that home prices could only go up, and if home prices came down, the whole system would be on the verge of collapsing. When he noticed that, not only did he notice that, he started putting his money into it. So he started shorting the entire housing market, and he actually had to go out and work with banks to create new short positions because banks couldn't fathom the idea that somebody in their right mind would want to short banks and the housing market, because banks and everybody was making so much money in the real estate market. So nobody ever thought that anything could ever go wrong except Michael Burry. Just so we're on the same page, when you invest in something, you expect this thing to go up, because when this thing goes up, you make more money. So if you buy a stock for $100 a share and it goes up to $200 a share, you just made $100. Shorting is the opposite. When you short something, you make money when this thing goes down. So when Michael Burry shorted the housing market, he made money because the whole housing market collapsed. And so when the whole housing market came down, he made money on this decline. Michael Burry has been pretty active and vocal about his positions and feelings about the market, because he says that we have a big bubble brewing. He says that we have a lot of traders that don't know what they're doing. He says that there's a lot of emotion in the market, and he says that all these things are really just building big bubbles. And so he's been talking about his concerns about the market on Twitter, and because of all of his tweets, the SEC actually started investigating him. And once the SEC started investigating him, the Securities and Exchange Commission, he shut his own Twitter down and he blamed it on the SEC. So now his Twitter at the time of me recording this video was empty because he deleted his Twitter because of the SEC investigation. But what we know before that is that he was very concerned about the health of the market. I made a video talking about his thoughts about the market and why he shut his Twitter down. If you want to watch that video first, I'll link it for you in the description below. Now, there's a little disclaimer. Let me just let you know that nobody can accurately predict the future. I don't care how good you are. I don't care who you are. Nobody can be right 100% of the time. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube or a random article. So Michael Burry is a very successful investor. He rose to fame and wealth after the 2008 crash, and he actually made a lot of money with the whole GameStop phenomenon, because in 2019, before the whole GameStop saga happened, he made a huge investment into GameStop because he thought it was a very undervalued company. So he saw that back in 2019. He put a ton of money into GameStop. And then after the whole GameStop phenomenon happened with Reddit and Wall Street Bets, GameStop rallied, and he clearly made a ton of money after that as well. So Michael Burry is a value investor. He likes to find undervalued companies, and those are the things that he wants to buy because he believes in the underlying fundamentals of the company, or he believes in the value of the company, and he thinks that the market is not valuing this company correctly, and if he feels that this company is undervalued, that's when he comes in and buys. On the flip side, he also finds companies that he believes are overvalued, and then those are companies that he comes in and shorts. So when he shorted the housing market, he thought that the housing market was way overvalued, there was too much risk, and he said that as soon as something goes wrong, the whole thing is going to implode. So that's why he shorted the housing market, and then when the housing market did implode, everything went down and he made a ton of money. Now he's doing the same thing with Tesla because he says that Tesla is way overvalued. So he has created a $500 million short position, which means he has bet more than $500 million because he thinks that Tesla is going to come crashing down. The thing that makes shorting so interesting and risky at the same time is if you short something, you make money when the stock or investment goes down. But if this investment goes up, you have to pay money, because many times brokerages or whoever is going to require you to put in more money, because as the stock goes up, now you're losing money, and so you are going to be required to invest more money to make up for this loss. And so when the 2008 crash happened, or before that, when he was shorting the housing market kept going up before it ultimately went down. And so when he shorted the market, he didn't know how long it was going to take for this market to go down. And as it kept going higher, he kept having to invest more money to the point where he almost went bankrupt. If you've seen the movie The Big Short, you saw it all kind of animated out. And so he knows the whole idea that if something goes up, you're going to have to keep investing more money. And so what we know for sure is that he probably started shorting Tesla back in 2020. And in early 2021, Tesla saw a massive boom. And that's when he came out and he tweeted, I just got the Market Watch article so I can quote it to you. He said, quote, well, my last big short got bigger and bigger and bigger too. And then he said, quote, enjoy it while it lasts. Because he thinks that kind of like the 2008 housing market, that yes, you can go higher and higher and higher, but eventually you're going to hit a tipping point if you do not have the fundamentals to support your valuation. Now, I don't think anybody is questioning Elon Musk's smarts or geniusness because he is a creative genius. I mean, he has had the idea to create electric vehicles and to send people to Mars, and he is doing it, implementing it, and he started from nothing. So Elon Musk is definitely a genius. What Michael Burry is saying is that he might not be the best business person because he says that the business, Tesla, is relying on regulatory energy credits. And the reason that Tesla has posted profits over the last year is because of these energy credits that Tesla is getting. And because of that, he says that Tesla will not be able to sustain their profits in the future. And on top of that, he says that Tesla has a lot of negative press because of car accidents and because of battery designs and because of scrutiny in China. Because of all these things, he says that it's going to be hard for Tesla to sustain their market share, and he just believes that it's going to be hard for them to keep their super high valuation, and because of that, he has been betting against Tesla. Now, the reason why this is so interesting is not because of Michael Burry versus Tesla. It's more of a Michael Burry versus Elon Musk, because Elon Musk has been really big promoting cryptocurrencies like Bitcoin. He came out and he said that Tesla was going to buy a whole bunch of Bitcoin, and he said that Tesla was going to accept Bitcoin as a payment, and as soon as he said that, Bitcoin prices started to skyrocket. And as soon as he did that, Michael Burry came out and he said that Bitcoin is one, quote, speculative bubble, and he says that a crash is coming. So this is a Business Insider article that I have with Michael Burry talking about Bitcoin. And he says the reason why Bitcoin is a bubble is because, quote, Bitcoin's price has surged to unsustainable levels and buyers have taken on dangerous amounts of debt. The reason why he says is a bubble is because he says a lot of people are buying Bitcoin hoping to get rich quick. And because they have this dream of just trying to get rich quick, they're buying Bitcoin not just with their own cash, but now they're leveraging up their trades and their investments. That way they can buy up a whole bunch of Bitcoin hoping they can make a quick buck. What he says is, quote, if you do not know how much leverage is involved in the run-up, you may not know enough to own it. What that means is if you don't know how much debt people are using to buy Bitcoin, you probably are not knowledgeable enough about Bitcoin to be buying it as an actual investment. So he says that people are buying Bitcoin not as an investment, but as a tool to get rich quick. And because of that, and because of all the debt that's fueling the Bitcoin price, he thinks that it is going to crash. The thing that I found that was really interesting about this article is that Michael Burry never said anything bad about Bitcoin or cryptocurrency itself, but what he was talking about was the prices and unsustainability of the current prices of Bitcoin. That's what he's talking about. He thinks that it's a bubble, but that doesn't necessarily mean that he thinks it is just going to completely fail and never be used. Kind of like how the dot-com bubble happened. The dot-com bubble happened and all these websites and dot-com companies crashed. But eventually, the internet came back and internet companies came back and became more sustainable. Just like the 2008 crash. The whole housing market turned into one big balloon and then it crashed. But then housing came back. I mean, we still use the internet, we still use homes. And so he's kind of saying the same thing about cryptocurrency. One of the quotes that I want to highlight for you is where Michael Burry was responding to people that kept saying that he's out of touch. He doesn't understand cryptocurrency, he doesn't understand the next generation, and because of that, that's why he's hating on cryptocurrency. And he responded to that. What he said was, quote, those saying me, Munger, Charlie Munger, and Singer are so out of touch are not considering that we have seen this all before and not just once. So what he's saying is that, yeah, people are saying that he's out of touch with reality, but according to him, he has seen this happen time and time again. So again, referencing the housing market, referencing the dot-com bubble, and so he's saying that this is a repeat of that. So now the natural next question is, what do you do? Should you be buying stocks, selling stocks, buying crypto, selling crypto? Well, first, you gotta have the right financial education. You gotta understand what investing is, and you gotta understand how stock market investing works. If you wanna learn more about that, our team put together a free PDF where we go through stock market investing and different stock market investing strategies. So if you want to read that PDF, I'll put the link to how you can download it for free when you subscribe to our daily newsletter. I got the link to how you can download it in the description below. Once you start to develop your investment education, you got to have a strategy for you and how you use your money. Because the issue and the mistake that so many people are making right now is their goal is to make money. Fine. And how are you going to make the money? Well, people are just buying up the next hot stock and hoping that it makes some money quickly. If it does, they'll sell it. If it doesn't, they lose money. What you have to decide is what kind of investor do you want to be and how much time do you want to put in the market? Because if you want to be a trader, you're going to have a very different strategy than if you want to be a long-term investor. If you're a trader, now you're trying to make money in the short term. You're trying to flip stocks and you're trying to make some money doing that. Nothing wrong with that, but you got to make sure if that's something you want to do, that's what you're researching and that's what you're actually doing. If you want to be a long-term investor, this is what you got to be researching. You also got to know how much time do you want to put in. And based off of that, you got to be making the right investment decisions that align with your goals. If this is your goal, you want to make sure you're doing things that are helping you be a long-term fundamental investor, not a trader. So you got to start by knowing what kind of person do you want to be. Do you want to trade your money that way you can make some quick bucks? Or do you want to invest your money that way you can build that long-term wealth? If you want to be a trader and you want to actually make some money, then you got to come up with a strategy. What are you going to be paying attention to indicate if something is a good time to buy? What is going to be your sell target? You have to know that if your stock goes up by a certain amount, maybe it's 20%, maybe it's 50%, at what percentage are you going to sell? And when you hit that point, you need to sell because you need to stick to your strategy. But you also need to have your risk management in place because if your stock goes down, you got to sell and cut your losses. You don't want to be one of those people that keep saying, oh, but this is such a smart investment. Maybe it'll come back up. I think it'll come back up. It has to come back up. Then you just keep holding as it goes down, down, down. If you are a trader, your goal is to make money quickly. And so if that is your goal, you're not trying to hold things out and wait for the fundamental analysis to turn it around because that can take years. If you want to be a trader, you got less than a year, many times just a few months. And so now if things go down, you want to cut your losses and then you want to go to the next stock. So you got to know where is that selling point. Maybe it's a 10% loss. If it goes there, you have to sell. And now you got to go on to the next one. And this will also help you if you see a crash happen, because if you're a trader, you're trying to make money in the short term. And if you see a crash happen, you don't want to lose everything. So you want to have these kind of like risk management systems in place. That way, if things turn around quickly, you want to make sure that you can exit and not lose too much money. If you want to be a long-term investor, this is where you got to be honest with yourself and tell yourself how involved do you want to be with your investments. Do you want to spend the time reading earning calls? Do you want to spend the time researching companies? Or do you want to just passively invest your money in the market and let the market slowly grow your money? Obviously, you can make more money if you're spending more time researching your investments, researching your stocks, and trying to find undervalued companies. But you also have to value your time. If you're not interested in that, or if you don't want to spend your time doing that, then you can be more of a passive long-term investor. If you are interested in that, then you can be more active in your long-term investments. And if you do that, you can also make more money. So you just got to understand how much time do you want to put in. If you tell me, Jasprit, I don't got the time and I don't really care about researching companies or following earnings calls. I just want to put my money in the market. That way I can see my money grow. That way I have the cash to afford some extra guac when I retire. Then what you should be doing is investing your money passively. And the easiest way to do that is by looking at ETFs or index funds. An ETF is an exchange traded fund. An index fund is very similar to an ETF. All these things is a fancy way to describe a basket of stocks. So now instead of you trying to go out and find the best company to invest in, you can just invest in a fund that gives you exposure to a whole bunch of stocks. Now, you don't got to worry about trying to find the hottest company or the hottest stock or an undervalued company. All you got to do is find an ETF in something that you're interested in. You can find an ETF that gives you exposure to the entire stock market, the general stock market. There are ETFs out there that give you exposure to the top 500 companies in the stock market. A couple examples of this are VOO and SPY. Again, I'm not telling you what to invest in, just an example. VOO and SPY are two different ETFs that you can invest in. They give you exposure to the top 500 companies in the stock market. Now, if the stock market goes up and these companies go up, you make money. If the stock market goes down and these companies go down, your stock price, your ETF price goes down. When you invest in an ETF like this, your risk goes way down because now you're investing in the general stock market or in a sector in the stock market, and you don't have to worry about an individual company failing or going bankrupt, because if one company in your entire ETF fails, well, you're okay. You might have a few hundred other companies in your ETF to keep your investment going up. So when you invest in an ETF, you have much less risk and you don't have to invest all of your time into managing your investment, because now every time you get paid, you can just put a little bit more money into this ETF and you don't got to worry about it, because now you're going to let your money compound and grow over time, over your career. Now the downside with the ETF is your returns might not be as high as they would be if you were spending all the time to research companies and to research the best stocks to invest in, but you get to save all the time when you're investing in ETFs passively. If you want to be more of an active investor, now what you want to be doing is something called fundamental analysis. What fundamental analysis is, you're going to find companies that you want to invest in, then you're going to look at their profitability, you're going to look at their revenue, you're going to look at their expenses, you're going to see how their revenue has been growing, you're going to look at their market share, you're going to look at their competitors, you're going to research who the CEO is, who the executives are, and so you're going to find companies that you believe in that are creating products that you like, and you're going to constantly be paying attention to what they're doing, how they're growing, and if you continue to like them, you will continue to keep investing in them. If you don't, then you might have to make a change. But when you're being a long-term investor that's more active, now you got to actually be researching your companies, and you got to pay attention to all the earnings reports. This is for some people, and it's also not for other people. You got to understand what your goals are. There's a difference between being a trader and being an investor. There's also a difference between a passive investor and being an investor who's more involved with their investments. Like Warren Buffett is a long-term investor, but he does this full time. He's constantly researching companies. Some people can build a lot of wealth without doing any of that. You got to figure out where on the spectrum you want to be, because everybody needs to be investing their money. You just got to figure out what's the best strategy for you. This is where everybody asks, okay, Jaspreet, so what should I be doing? Should I be buying or should I be selling? Well, the answer again is going to depend on your strategy. If you're a trader, why are you selling if you don't hit your sale target either up or down? That's what you should be doing in order to sell. If you are a long-term investor, if you're trying to be passive, now you should just be buying more every time you get paid. It is just kind of like a system where every 2 months, every month, you just want to keep throwing your money in the market. This is called dollar cost averaging, where now you're consistently putting more money into these ETFs or funds. That way you let your money grow and compound over time. If you want to be an active long-term investor where you're looking for undervalued deals, then you should only be buying if you actually find an undervalued deal. If you think that the market is too hot right now, then you would wait until you find a better deal. If you think that the market is undervalued, then you would come in and buy. Likewise, if you own something, you should be selling if you think that has become too overvalued or if you hit your sale target. If you haven't, then you would continue to hold. So again, what is the right thing for you is going to depend on your strategy. I do not like telling people you need to sell, you need to buy. I think that's a very dangerous and a very kind of immoral thing to do, because what's good for me might not be good for you. I mean, I could come up here and say, hey, this is a really good stock to invest in, but this might be a good stock for 6 months or 6 years. If it's a good stock for the long term, you might lose money for the next 6 months, and then you're gonna say, Jaspreet, I lost money in the stock. Well, it just depends on your strategy, right? Because if you were only holding it for the next 6 months and it went up over 6 years, if you would have held on to it, you would have made more money. That's why I need you to do your own due diligence and research. That's why I don't come here and give you stock picks. I want you to have the right education. That way you can find the right strategy and then have the right education to find the right companies to invest in. If you enjoyed this video, here's a video on how to start generating passive income that I think you'll love. And while you're at it, download our free stock market PDF. And as always, keep hustling. The first property I ever bought was a small condo, and when I bought this property, I found a property manager, and this property manager wasn't finding a tenant very quickly, so I went out and I found a tenant for this property.